Welcome to Real Estate Economics webinar series. I'm John Mulvo and I'll be leading us through a look at the Las Vegas, Nevada MSA this morning. As many of you are aware, some of the most deeply impacted housing markets across the country are starting to show much greater signs of stabilization, price recovery, employment recovery. This is particularly true in the desert Southwest, Las Vegas, Phoenix, also some of the areas that were highly exposed to subprime, such as the Inland Empire of Southern California. In Las Vegas, this area suffered tremendously from the drawdown in construction employment and also tremendous weakness in leisure hospitality relating to the gaming sector back in 08, 09, and 2010. Suffered a tremendous loss of jobs, but we've started to see a rebuild in the employment here, so that the last year we've picked up about 10,000 jobs between June 2011 and June of this year. A little bit erratic with some fits and starts in the data, but a gradual trough in the employment side here, and also, as we'll discuss later, in the real estate value side. On a year-over-year basis, in terms of the large sectors that dominate this economy, leisure and hospitality is by far away the winner. That's hardly surprising with the gaming industry here. But the number of jobs that were gained here in leisure and hospitality is a very large percentage of those gained nationally in this same sector, again suggesting what we've all heard, that many people are taking their vacations domestically instead of going overseas and to someplace where you'd have to fly. Many people are just taking that week or weekend getaway to Las Vegas. This area has continued to suffer in construction, government employment, and also some business professional services and financial activities. So the picture's mixed, but what we're starting to do is see some larger growth in the stronger sectors. Here's how this area breaks down in terms of supersector. Obviously, the 800-pound gorilla in the room is leisure and hospitality. That's really followed by construction and government. The construction sector here is about 19%, and the government sector is about 11%. So if you put those together, you have almost 2/3 of the jobs in this MSA. Now, construction work tends to be very economically sensitive. Leisure and hospitality has also, and the government sector obviously has been suffering nationally from revenue shortfalls, budget deficits. So this is an MSA that's got a job base that faces some challenges ahead and is bound to react to economic events and economic news, which ought to be pretty exciting over the next year. If you look at the past history on the employment in this particular sector, you can really see where the trouble began. Back in 2007, now recall this is before the Great Recession, before Lehman Brothers, before the credit markets really started to unwind. Job growth really slowed down in this market, going from over 50,000 in 04, 05, and 06 down to just 10,000 in 2007 before several years of large losses started to take place. Now we've sort of caught our feet here in 2011, no improvement, so to speak, over 2011 and 2012, with a couple of better years on the horizon. But remember, this area is built on leisure, hospitality, government, and construction, so we face some challenges in terms of employment in this MSA. You can see where we are in terms of total growth. The 2012 numbers are about 812, almost 813,000. Which really puts us about a little bit ahead of 09 and a little bit ahead of 2004, but not really close to the subprime years where we built so many jobs here based on high levels of construction activity. Some of the other sectors should be contributing more in the next few years, so we have a fairly decent forecast here, but again, it comes back to what are the capabilities for job growth in gaming, leisure, hospitality, construction, and government. I'd like to take a look at the transaction patterns. This is for a single year of 2010, and we will show 2011 and 2012 in the subsequent slides to put this all into perspective and start to show you what's been happening on the ground in this particular market. as of June 2010, the foreclosures and foreclosure sales were capturing almost 50% of the total market. New builder sales were surprisingly robust, 12.8%, and resales only 37.6%. Now let me note, resales here is a category that includes short sales, so we'll see a transition and a shift in how this market's behaved over time. Let's come forward to 2011. Foreclosures and foreclosure sales are still more than 50%, about 60% at this point in time. New builder sales aren't doing that well, but resales are starting to pick up a little bit here. Banks and lenders are finding that their short sales are getting greater market exposure, getting higher recoveries than a conventional foreclosure on the courthouse steps. So they're gradually resisting repossessing any homes, or not repossessing as many homes as they can, and sending those out to the short sale market. Come forward to 2012, you see a huge increase in the resale category, many more homes being short sold. New builder sales about the same, but the direct foreclosure activity now is cratered all the way down to about 11.5%, and foreclosure sales 23.1%. So foreclosures are lagging foreclosure sales tremendously. Think of the impact on the pipeline here. Foreclosure sales are gradually cleaning out asset management backlogs, letting them handle new business, if you will, and foreclosure sales are going to draw down quite quickly in favor of short sales here. Now this sort of has an unintended consequence of helping the new home market over time. If conventional owner-occupants can't really get into the short sale market due to high down payments, and who wants to really buy a home on the courthouse steps as an owner-occupant, that will send a lot of demand into the new home market in the next few quarters. We'd like to look at full year sales transactions by price range here, and we found this to be very interesting. Highlighted here is the under $99,000, very affordable housing, even for this market. Look at the full year 2009, 2010, 2011 data. Full year 2011 has 3,000, about 3,400 more transactions under 100,000 than did 2010, and about 4,000 more than 2009. So this is rental investors coming into these markets, buying the most affordable properties that are available and sending those into the rental pool. We've heard many stories about people paying as little as $30,000, $40,000, $50,000 for a condo or house in this market that can immediately be re-rented or rented at $750, $850, $900. Even if you make 100% down payment, if you do the math on that, the cash-on-cash returns are 20 or 25%. Now, one other thing we'd like to call your attention to here is the volume in that under 100,000 category is larger than the volume from 200,000 on up. So this remains a market that's being dominated by rental investors. There are owner-occupants that are active. There are some new home sales, but the volumes are tremendously weighted towards rental investors. Now, we've also heard from the rental investors that the availability of homes isn't as great as it once was. People are being forced up the price ladder, paying a little bit more for homes, seeing some yield compression, having to take more challenging deals. The paint and carpet and immediately rented out deals are not as easy to find, and you find your opportunities face more challenging pictures of structural problems and more expensive rehab and improvements. So that comes with the market territory. As more and more people get into this, we're bound to see some yield compression. Let's look at the overall distressed housing picture the last couple of years. You can see the notices of default initially skyrocketed back in 07, 08, 09. That was, of course, extremely alarming to the market to see the trajectory of the NOD trends. But think about that. There's many of these owners had first trust deeds, second trust deeds, all kinds of junior liens, and so there could have been multiple filings on the same property. Properties went in and out of the process, so those numbers got to be very large. By comparison, foreclosures and foreclosure sales still huge, are nowhere near the NOD numbers. And these are gradually ratcheting down, really facilitated by activity by rental investors. We think by the time you're into the 2015, 2016, 2017 market, most of the remaining distressed inventory is going to be homes of relatively poor quality, the stuff that hasn't been able to be sold in the last several years. This graph paints a picture of new home construction with distressed inventory added on, and you can really get a sense for what had happened in this particular market in 2007 and 2008. The total housing availability remained at subprime levels about the same as 2004, 2005, and 2006, even though we knew and know that demand was tremendously depressed by 2008 and 2009, but supply and availability wasn't. You take the fewer number of new home sales and add the distressed inventory, and you still have high availability numbers during those years of really 2008, 2009, 2010. Now, as you can see, we're starting to get a little bit of a trough here with the transition away from distressed inventory and back toward conventional new homes, providing a greater percentage of the supply. So let's look at the supply and demand patterns in this market. If you've seen our webinars in the past, you've heard us talk about how the supply is very closely linked to employment. When employment grows very quickly, it's hard for the supply to keep up. So when people flood into town, they're building casinos and there's a lot of construction going on, the demand for housing can run away from the supply for housing quite easily. It is hard, even in a market like this with abundant land, for the supply to grow as rapidly as the demand is capable of at certain times. Now, we hit the Great Recession, this all reverses, people lose their jobs, suddenly the employment base is too small for the supply, so you get this softening of demand that you can see in 2008, 2009, 2010, and we still have that now. We need the employment base in this market to grow through the next 4 or 5 years before we can get back to a condition of supply-demand equilibrium. So let's look at valuation here. We've got historical or our forecast of median home prices shown in blue with that big spike in the middle and then that huge cratering and trough thereafter. Shown in green is supportable median home price, and what that is local incomes times the interest rate multiplied by a factor which we know people will pay towards their home loan. Now look what's happened with the supportable median home price over this time period. It's gone up and up really back since the 90s through the mid-2000s in an environment of declining interest rates. Rates had been declining back into the 1980s and continued to do so through this whole time period. Look right after values crater in about 2009, the supportable median home price continues to go up because rates are so low. People could take that same income, multiply that by a new lower interest rate, and afford a little bit more home. Now, they weren't doing this because of shaky economic conditions and their own employment specifics, but the supportable median home price expanded even during a time period of difficult economics. Now we see, beginning in about 2013, 2014, that starts to reverse as we probably are getting some higher mortgage interest rates in the outer years of the forecast. Gradually, the separation between that green line and that blue line, that's our undervaluation. Housing in this market is deeply, deeply undervalued. That's what's pulling in the rental investors, and over a period of 3 or 4 or 5 years, we'll gradually see equilibrium be restored in this particular area. So what's really our conclusions about this market? We know that employment remains weak. It's one of the highest unemployment states in the nation. We've talked in our California webinars about how California's been lagging the national recovery. Well, so has Nevada. Nevada's got some serious budget problems. Their sector weightings that we've talked about in terms of employment are maybe not suspect, but all have their challenges, making job growth a lot of sustained job growth very difficult in this area. Market's tremendously undervalued. We talked about this. One of the big surprises we've seen is the improvement in the lending market. We know that people who short sold their home in 07, 08, or have been foreclosed are back in the market. The remodelers are telling us that FHA will make people a loan with very small down payments, and if the seller will contribute a couple of percent, people with relatively small assets and small down payments can still buy a home. And people have compared it in some markets to subprime revisited. We'll have to see how that plays out, but the improvement in lending has really been amazing. The other thing we've seen is that remodelers have access to capital in amounts that we would have found just stunning a few years ago. Warehouse lines, just like we had in the subprime days, is making capital available to remodelers at rates and in volumes we would have never suspected just a couple of years ago. We saw earlier how 33% of this area's job base was tied to gaming. Now, gaming has been quite challenged internationally and has also been challenged here. Online gaming and improved gaming in Asia and the Middle East has been hurting the market a little bit here. I think all the public companies have reported softer gaming revenues in the past few quarters. Now, that might change as people stay home on vacation, but it's a confidence thing. We'll have to see quite a bit more economic confidence before people want to travel and game to the extent that they had in years past. This is an area with tough public schools, so it's not always a family market. It tends to cater to highly mobile parts of the workforce. The construction workforce is very mobile. The people who work in gaming tend to be very mobile, so that's a factor in the buyer profile in many of these places. We talked about weak state finances. We know that we have many buyers coming out of California looking for low-tech states to retire, cash out their accumulated equity in California's coastal markets, and go look for some place where they can acquire some retirement housing. To some extent, this has been favoring Arizona over Nevada, since services are under tremendous pressure in Nevada, and people are uncertain that social services and medical services and that sort of thing are sustainable, on a sustainable trajectory in Nevada. And last, we see a lot more people renting for a couple of years. I know that's no surprise to anyone. Many of those people, once they pass their 2 and 3 year marks, vastly prefer to own and will own again in the future. It's just a situation where a conventional single-family house will transition back and forth between the rental market and the for-sale market as economic conditions require. Please call us if you have any questions about today's webinar. I'm John Mulville. I'm happy to field questions about anything we discussed today, the larger housing market in general. Come to our website for upcoming webinars. You can see what we have scheduled in the next few months, and take a look at our market data. Much of what we presented here today is from our residential economic report, and a sample can be viewed on our website. So enjoy the Las Vegas market. Call us if you have anything interesting you'd like to share with us. We greatly appreciate any dialogue, and we always enjoy talking with people in the field. Thank you very much. Join us for our upcoming webinars.